Okay, let's unpack this. Welcome to the deep dive. We are so glad you're here with us today.
Absolutely.
We're the show that takes these incredibly dense financial documents, earnings calls, transcripts, you name it, and we break them down to what you actually need to know.
So you know your time is valuable.
It is. And today, our mission is, well, it's laser focused. We are tearing apart the Q3 2025 earnings call transcript for Getty Images Holdings. The ticker is GETY.
And this isn't just about, skimming the headline numbers, not at all. We're looking for the strategic pivots, the critical headwinds, and really the subtle financial levers that Getty is pulling right now.
They have to navigate a really volatile market.
A seriously volatile market, and we need to get past those top-line figures to understand how these huge macro factors, things like the comparison to the 2024 Olympic year, which was massive.
Yeah.
The lingering shadow of the Hollywood strikes and this general softness in the agency business, how all that is colliding with their big strategic moves in AI, and of course that big merger.
Exactly. Our goal here is to give you a shortcut, a comprehensive one, to understanding the health and the future direction of one of the world's most important content providers.
Right.
So we've structured this to give you the prepared remarks first, to set that financial baseline, and then we are going to dive deep into the Q&A.
Which is always where the real story is.
That is where the strengths and weaknesses really get revealed. Now, before we jump in, a quick but a really crucial piece of housekeeping.
Please.
If you value this kind of in-depth analysis, please take a second and click that like button right now. Share this deep dive, subscribe to the channel so you never miss a beat, and, stay tuned.
We've got a lot more coming. Ready to go?
Let's do it.
Okay, let's start with the prepared remarks. This is what sets the stage for Q3 2025, delivered by CEO Craig Peters and CFO Jen Leyden.
So the headline numbers, at first glance, they look remarkably flat.
Deceptively flat.
Very deceptive in a market where content and tech are just shifting so fast. Getty Images reported Q3 2025 revenue of $240 million.
Right.
That figure was basically flat year over year. It showed a tiny decrease of 0.2% reported.
But then you have to look at it currency neutral, which is key.
Always. And on that basis, which strips out all the currency fluctuations and gives you a much cleaner operational picture, revenue was actually down 2%.
So that flatness, right away, it signals that there are some underlying market dynamics that are slowing things down.
For sure.
And that flat revenue, it translated directly into their profitability. But, and this is important, with a few critical caveats we need to talk about right now.
Okay.
Adjusted EBITDA came in at $78.7 million. That's a 32.8% margin.
Which looks a little depressed.
It does. It's down 4.4% on a currency-neutral basis. But management was, they were extremely quick to guide investors to look past that number. They argued that the margin was deliberately impacted by these accelerated non-recurring costs.
Hold on. You're saying they intentionally took a hit on their profitability this quarter. That's not something you see every day. Why would they do that?
Well, it was a conscious strategic choice. They're trying to accelerate their regulatory and legal readiness.
Okay.
Specifically, they said, look, you have to exclude $3 million in professional fees. These are tied to accelerating their SOX compliance efforts.
Okay, and there was more, right?
Yeah, plus another $1 million spent specifically on that ongoing and very critical litigation with Civility AI.
Okay, let's clarify those costs for you listening.
Yeah.
What exactly is SOX compliance, and why is that costing them an extra $3 million this quarter?
That's a great question. So SOX is the Sarbanes-Oxley Act. It's a U.S. federal law, and it mandates that companies maintain these really rigorous internal controls over their financial reporting.
Right, the ICFR.
Exactly. And since Getty went public through a SPAC, they have a required timeline to get to full accelerated compliance status. And that demands a huge investment in auditors, consultants, new IT systems.
So they're basically paying to compress the timeline.
They are. That $3 million is accelerated spending. They're expecting to spend about $8 million total for the full fiscal year 2025.
So if you strip out that $4 million total, the 3 for SOX and 1 for the legal defense, the underlying adjusted EBITDA margin would have been a much stronger 34.5%.
Much stronger.
That tells us the core operational efficiency is still very high. They're just paying a price right now for future regulatory stability and for, aggressively defending their IP in court.
It's a deferred benefit. That's a perfect way to put it.
A deferred bear.
Precisely. Now, let's dive into where the money's actually coming from, because this quarter, it tells a classic, really complex tale of two different segments, creative versus editorial.
And this is where the comparison periods, the comps, they become everything. Let's start with creative, which on the surface looked like a spectacular growth story this quarter.
It really did.
Creative revenue was up 8.4% year on year, or 6.4% on a currency neutral basis, hitting 144.9 million.
And that 8.4%, that is the most misleading number of the entire quarter. And we need to understand why right now.
Okay.
So the company said this massive growth was primarily due to two major factors, and they're either non-recurring or normalization factors. The first was a large multi-year premium access or PA agreement that they renewed,
A big enterprise client.
a big one. And that deal included a meaningful amount of upfront revenue recognition. That is a one-time quarterly boost. It's not an annualized growth trend.
And the second factor is what management called the normalization of revenue allocation. Now, it sounds technical, but it is absolutely crucial for understanding Getty's recurring revenue model. Can you walk us through the mechanics of that?
Absolutely. So Getty's largest subscription product, Premium Access, it bundles both creative and editorial content together. The revenue from those long-term PA contracts, it has to be allocated between the creative and editorial segments. And it's based on how much the customers actually use of each type of content.
So it's based on downloads.
Right. And in Q3 2024, last year, we had an incredibly strong editorial event calendar. The Paris
Sure.
Olympics warm-up, the high-intensity election cycle, and all of that skewed customer consumption heavily toward editorial content.
Ah, I see. So because editorial was being used so heavily last year, the accounting system gave a disproportionately high amount of that PA revenue to the editorial segment in Q3 2024,
Correct.
which effectively penalized Creative's reported number for that quarter.
Exactly. We can call it the ghost of the Olympics, just skewing the balance sheet.
I like that.
And because Q3 2025 didn't have a comparable mega event, the subscriber download patterns, they just returned to their normal, more balanced levels.
Which means Creative automatically got a bigger slice of the PA revenue pie, just by comparison.
You got it. The CFO estimated that this right-sizing created about half of this year's 6.4% currency-neutral creative growth. It wasn't true organic strength. It was a return to normal.
That really tempers the excitement around that 8.4% figure. So you're saying a huge chunk of creative growth this quarter was basically just an accounting correction.
A huge chunk.
Should investors just treat that number as noise, or is there any true organic growth baked in there?
They are definitely, they're guiding analysts toward treating it as heavily inflated noise. We'll see that confirmed later in the Q&A.
Okay. Yeah.
But even with that noise, we cannot ignore the persistent, really significant headwind they are facing, which is the agency customers.
Right.
Jen Leiden noted that the agency business, which sits entirely within creative and is highly sensitive to macro advertising budgets, it continued its steep decline. It was down a shocking 22% year on year.
Wow, 22%. That's not softness.
That's a collapse. This reflects that broader macro uncertainty, and it remains the primary sustained pressure point against the entire creative business. A 22% drop is a collapse in that segment.
Ouch. Yeah, that is a collapse. That makes the 8.4% creative growth look truly synthetic. Okay, now let's flip to the other side. Editorial.
Right.
Editorial revenue was 89.3 million, and it was firmly in decline. It was down 3.7% reported, or 5.6% currency neutral.
And that decline is really straightforwardly explained by the difficult comparison to Q3 2024.
Back to the ghost of the Olympics.
Back to the ghost. Last year had that very strong editorial event calendar, as they put it. So news and sports segments saw double-digit decreases year on year in Q3 2025 because they just didn't have the same level of event-driven consumption to compare against.
So the underlying business is sound. It's just the calendar comparison is brutal.
It's brutal in the odd-numbered years, exactly.
Yeah. The only thing that kind of helped there was some growth in entertainment and archive segments, which partially offset those steep declines in news and sports.
Yeah, that long-tail content.
So while the event-driven editorial is volatile, that long-tail stuff, historical images, entertainment coverage, that's holding up and providing some ballast.
A little bit, yeah.
Okay, let's shift gears dramatically. Let's talk strategic initiatives. Because while the top-line numbers are flat, the future of this company is really being decided in these strategic moves. Let's pivot to AI.
Yes.
That's where the real complexity lies.
Indeed. Craig Peters noted that revenue from AI data licensing was actually down from 2024 levels.
Okay, that's critical context.
It is, because it's not that the market dried up.
Hmm.
It's due to the accelerated nature of prior year revenue recognition for certain big data licensing deals.
So they recognized that revenue really quickly in 2024.
They did, which means the comparison year, Q3 2025, it just looks artificially weak by comparison.
So the dip in Q3 25 isn't a failure to find new deals, it's just a reflection of how they booked the money before.
Exactly.
What's really fascinating, though, is the strategic shift Peters described. He called it a move towards traditional content licensing in the AI space. They're changing the game.
That is the key pivot. Getty is moving beyond just selling these huge raw data sets for AI training, which was the initial gold rush, into partnering with tech platforms that are using content within their finished customer-facing products,
They want to be integral to the application.
not just the training.
Yeah.
And the big concrete example they gave was the new multi-year agreement with Perplexity.
The search experience that's growing so fast.
Yep.
And this deal is so structurally significant because it maintains the fundamental value chain of content licensing. It allows Perplexity's model and its search to use Getty content, but, and this is critical, the agreement includes explicit commitments for both image credits and link backs.
This is a huge statement. It means Getty is ensuring that as AI uses their content to generate responses or support search results, attribution is a non-negotiable part of the deal.
Which pushes back against that whole model where content just gets absorbed into a generative black box, right?
Completely. With no provenance, no credit. By securing those link backs and credits, they are maintaining the content value chain even in the age of generative AI.
Yeah.
It validates the professional content market.
They also mentioned another opportunity in their custom content business,
Right.
leveraging that huge global contributor network to create specific, bespoke training content for a business customer. This is essentially creating high-quality, targeted training data on demand.
That's exactly right. They're using their scale and their quality control to provide high-quality content at scale on an economic basis, just like they always have. But now that content is explicitly being engineered for machine training.
It's an extension of their traditional model.
Right into the AI domain.
Okay, so moving from strategic licensing to strategic mergers, we have to talk about the financial elephant in the room. The proposed merger with Shutterstock.
Which has been stalled.
It has.
Unfortunately, the timeline got substantially delayed by regulatory scrutiny. The UK's Competition and Markets Authority, the CMA,
UK's primary regulator.
referred the deal to what's called a Phase 2 review process. And Craig Peters, he said they were disappointed. He noted they believe the transaction doesn't reduce competition and that they had offered comprehensive remedies to avoid this whole thing.
But despite that disappointment, the company says they are 100% committed to the transaction.
They do. They stress it's primarily about achieving significant cost synergies that they believe are necessary for future efficiency.
The commitment is there, but the regulatory reality is stark.
It is. This Phase 2 process pushes any potential close date well into 2026. And this delay, it has a very tangible, immediate financial cost, which we need to quantify right now when we get to the debt and financing piece.
Okay, but before we get to the cost of waiting, let's talk about the major legal win they secured in the UK against Stability AI. This has huge industry-wide implications.
Oh, this is potentially transformative for the entire generative AI legal landscape.
Yeah.
Getty received a judgment in the UK against Stability AI, and it ruled in their favor on the trademark infringement claim.
And what was the crucial principle here?
The court confirmed that including Getty trademarks and watermarks in AI-generated outputs, well, that infringes those trademarks.
And the really big precedent-setting takeaway.
The ruling confirmed that the responsibility for those infringing outputs rests with Stability AI, the platform, the generative engine, not the end user who just typed in the prompt.
Wow.
Exactly. This decision puts the entire onus on the generative platform to ensure their training data and their outputs are clean and licensed, which is massive for rights holders trying to protect their brand and their content.
Getty hailed it as a win for rights holders everywhere.
And they're right to, because it affirms that platforms can't just wash their hands of liability once content is fed into their models. It provides the legal scaffolding for their whole attribution strategy, like we saw with the Perplexity deal.
Okay, let's dive deeper into the core health metrics, specifically subscription health. That's the foundation of their recurring revenue model.
And that recurring model is definitely the most robust part of the business. Annual subscription revenue now makes up 58.4% of total revenue.
That's a big jump.
It's a significant jump from 52.4% in the prior year period. And that segment grew a very healthy 11.2% year on year.
And the undisputed superstar of that segment is Premium Access, or PA. That's what targets their largest enterprise customers.
Right. It now makes up just over one-third of total company revenue.
Hmm.
And it grew 17% or 15% currency neutral.
And that massive growth was attributed directly to that large renewal we talked about earlier, right?
Directly. An upsize in scope and term for a major long-term customer.
Okay, so if you look at the subscriber metrics, they added 6,000 net active annual subscribers in the Q3 last 12 months period.
LTM, yeah. Bringing the total to 304,000. And that growth was primarily driven by gains in Unsplash Plus.
Which is their offering for SMBs and the creator economy.
Right.
However, those gains were partially offset by a decline in their iStock brand.
Which happened because they had to discontinue a free trial customer acquisition program back in June 2025.
Right. And this shows that while the enterprise business, PA, is incredibly sticky, customer acquisition in that small to medium business and freelancer space is really sensitive to promotions.
More volatility.
A lot more volatility. Okay, let's talk retention, because there was a notable drop even if they explained it. The annual subscription revenue retention rate fell to 90.3% in the LTM period.
Which is down from 92.2% in the 2024 period.
Huh.
And yeah, that dip could raise a red flag, but management gave some really crucial context.
And that context connects directly back to what you called the ghost of the Olympics.
It does. They attributed this decline primarily to the absence of the one-time a la carte subscriber spending that was associated with the major political and sporting events that boosted revenue in 2024.
Okay, so what that means is it's less about customers walking away from their core annual contracts and more about them just not making those extra high-volume project purchases this year.
Because the massive event calendar didn't exist.
Right.
When you have a mega event year, your subscribers spend more on a temporary basis, and that artificially inflates the retention metric. When you go back to a normal year, the metric dips, even if the core recurring revenue is stable.
So the company just views this as comparison noise.
Not a structural churn issue, correct.
Let's quickly touch on the geographic context, which also reflects that macro weakness. The Americas, their largest region, saw a modest currency-neutral growth of 0.8%.
The EBA was down 4%, and APAC was down significantly 10.8%.
And that APAC decline is really steep.
It is. And the company confirmed this was due primarily to the persistent declines in that agency business. It highlights just how globally exposed that agency weakness really is. When the major agencies pull back spending, the drag is felt across multiple continents.
Okay, let's nail down those cost increases we mentioned at the top. SG&A expense was up slightly, but the underlying drivers were those one-time accelerations.
Yes, driven almost entirely by the $3 million for the accelerated SOX compliance. And as we noted, that's $8 million total expected for the full year, and the $1 million for the litigation with Stability AI.
So without those proactive one-off investments, their cost base was pretty well managed.
Very well managed. They're consciously investing for the long term in both governance and legal protection.
Now for the real finance deep dive, the debt profile and the quantifiable immediate cost of that pending merger delay.
Getty's total debt outstanding as of the end of Q3 was $1.38 billion. It's composed of various notes of term loans. Their net leverage ticked up slightly to 4.3 times.
It's a little up from 4.2 times in Q3 2024.
And Jen Leiden pinpointed the cause. It was the impact of the weaker dollar on the value of their euro term loan debt.
A minor currency impact, but worth noting.
For sure. But the most expensive detail, that relates directly to the Shutterstock merger financing. The delay is not free.
Not at all.
In October, they issued $628.4 million of new 10.5% senior notes due 2030.
That's a high coupon.
Very high. And this financing was structured specifically to fund the merger and refinance some of Shutterstock's debt.
But because the merger is now trapped in that Phase 2 CMA review, all those funds, that $628 million, it's just sitting in escrow.
It is. It's in escrow, earning a much lower interest rate than the 10.5% they're paying.
And that gap has got to be costly.
It's very costly. The CFO highlighted that while those proceeds are locked up, the financing carries an approximate net interest cost of $3.5 million
Huh.
per month.
Wow. 3.5 million a month.
Think about that. That's a six-figure drag every single week.
Right.
It's $42 million on an annualized basis that is purely the tangible price Getty is paying for this regulatory delay.
It's an enormous non-operational expense.
And you can be sure analysts are watching it closely because it's going to continue until the deal is either finalized or terminated, potentially for another 3 or 4 quarters.
Okay, finally, let's wrap up the prepared remarks with the updated guidance for the full year 2025. What does the company expect based on all these tough comparables?
Management narrowed the revenue guidance slightly downward. The new range is $942 million to $951 million.
Okay.
On a currency-neutral basis, this represents a really tight range of a 0.5% decrease to a 0.5% increase. They're basically guiding for flat to slightly positive growth.
And the adjusted EBITDA guidance.
That was narrowed to $291 million to $293 million.
So both of those updates, they reflect the odd year versus even year calendar comparisons, right?
They do, which heavily hit the second half of 2025. And they also reflect the continued lag in the return of pre-Hollywood strike production levels. They're managing expectations down based on the tough comps and the ongoing macro softness.
Which makes this Q&A section we're about to get into absolutely vital for understanding the underlying health. That brings us out of the scripted remarks and into the Q&A, which, as you said, is often where we find the most clarity on strategy and risk. This is where the company faces those pointed questions.
Right, from analysts who are trying to understand the underlying drivers and the risk profiles of the metrics we just talked about.
And the analyst community, they really zeroed in immediately on 2 areas.
The true nature of that creative growth and the sustainability and economics of the new AI licensing strategy.
The first set of questions came from Jay Keller, representing CITI. And Keller, he immediately jumped into the core strategic issue of AI monetization.
His question was dense. It focused on Getty's key AI initiatives, how they tie back to the overall strategy, and, importantly, what the potential revenue impact might look like in 2026.
And he specifically wanted to understand the structure and benefits of that new Perplexity partnership.
The one requiring attribution and linkbacks.
Yeah. He also added a quick, very smart follow-up. He asked if bundling AI capabilities into their iStock subscriptions is actually driving new customer acquisition, retention, or upsell.
In other words, is AI a feature that actually moves the needle on their core subscription metrics?
Exactly.
So Craig Peters, the CEO, he responded. He maintained the confidentiality of the Perplexity deal, of course, but he confirmed it is a classic licensing deal.
And one of several they signed.
One of multiple such deals they signed in the quarter. It's part of a broader strategy to partner with tech platforms using content in their product offerings, not just for training.
Which confirms that pivot to contextual licensing is broad. It's not a one-off.
Not a one-off. But Peters was, I would say, skeptical that AI functionality is currently driving new customer growth. Yeah, he made it clear that while they're happy to make AI tools available to existing customers, from a new customer standpoint, pre-shot content, the traditional curated library, that is still the primary driver for acquisition.
So it's still too early to project 2026 AI revenue.
He said exactly that. It underscores the nascent early-stage nature of this revenue stream.
And then he formally defined their approach.
He did. He called it the 3 revenue legs of AI, which is a really useful framework for us.
Okay, what are they?
First is traditional licensing, like the Perplexity deal, where they license content for use in a specific application. Second is data licensing for AI training, which they're still pursuing, but with slower revenue recognition now.
And the third leg.
The third leg is the internal deployment of AI. This is focused on operational efficiency and cost control within their own company, using AI tools to better tag content, improve search, control expenses.
That's the crucial, often overlooked cost savings component of their strategy. It's an investment in their own infrastructure.
So Keller followed up on that, and he pushed for more detail on customer segment health, especially given that dramatic 22% agency decline.
Right. He asked for a specific update on their 2 largest non-agency segments, corporate and media.
And particularly regarding the recovery of broadcast and production subsegments after the Hollywood strike.
This question gets right to the heart of the underlying economic health, beyond all the one-time revenue allocation shifts.
It does. And Jen Leyden handled this one. She started with media. and she confirmed that media revenue was in decline by about 3% in Q3.
Okay.
And the decline within media was explicitly localized. It was concentrated primarily within the broadcast and production subsegments.
The parts of the business most tied to film and TV output.
Exactly, the parts that rely heavily on that continuous cycle. And she noted that while the decline isn't as steep as it was during the height of the strikes, those segments are still not back to pre-strike performance levels.
So the recovery is proving to be slower and bumpier than the industry had hoped for.
Much slower. Then she shifted to corporate, which is the company's largest and most crucial revenue segment. It's approaching 60% of their total revenue base. This is their ballast.
And what did she say about that?
Well, while corporate saw a slight decline in Q3 overall, she reaffirmed that it remains, broadly speaking, a growth segment. And crucially, the enterprise customers within that segment maintain very, very healthy retention rates,
Close to 100%.
close to 100%. This reconfirms that their largest revenue base, built on those premium access contracts, is highly durable and sticky. And that is a major counterweight to the volatility we're seeing everywhere else.
Next up was Mark Gedowitz from Benchmark, and he focused specifically on that undisputed star performer, Premium Access PA. He asked for specific retention rate comparisons for PA between Q3 and Q2, and more importantly, how PA compared structurally to the retention rates of their other subscriptions. He wanted to isolate the true durability of those high-value customers.
And Craig Peters addressed this directly. While they don't give out specific quarter-over-quarter retention stats for PA, he did provide crucial context. He emphatically confirmed that Premium Access is their largest subscription offering,
A third of total revenue.
about a third of total revenue, and it maintains their highest retention rates across all of their subscriptions.
He used some strong language, didn't he?
He did. He called it an incredibly durable offering, with consistent performance year over year and quarter over quarter. It shows virtually no variability in recent periods.
That is exactly what enterprise investors want to hear, that their core high-dollar contracts are insulated from all this macro noise.
And this high durability, it contrasts sharply with the retention they see in their smaller brands. Peters noted they naturally see higher churn levels in iStock and Unsplash.
The ones that target small businesses and freelancers.
Right, and that's expected behavior. Those segments typically see higher subscription volatility than massive enterprise customers locked into multi-year PA deals, especially in a tightening economy.
He also confirmed high utilization.
Yeah, he did. He reinforced this by noting that high utilization, shown by paid downloads, confirms that subscribers are actively using the content they pay for. It signals genuine need, not just a passive contract.
Gedowitz then returned to the creative revenue figures. He asked which customer cohorts actually drove that sequential recovery in Q3. And maybe most pointedly, he forced the company to give some insight on the Q4 forecast.
This was the moment of truth.
It really was. The moment of truth regarding that inflated 8.4% creative growth.
And this led directly to what we call the creative warning. Greg Peters explicitly cautioned analysts and investors against reading too much into that impressive Q3 creative growth number.
Because of the transient nature of the drivers.
Exactly. This is management actively managing expectations downward.
And Jen Layden, she quantified the drivers, confirming our earlier analysis. She said approximately half of the currency-neutral creative growth in Q3 was due to that right-sizing or normalization of the PA revenue allocation.
The accounting correction from the 2024 Olympic cycle,
Right.
and the other significant chunk, a little less than half, came from that one-time multi-year deal with healthy upfront revenue recognition.
Which is legitimate revenue, but it's a non-recurring quarterly skew.
It is. And when you remove that allocation noise and you remove that upfront payment, the underlying organic creative performance was still being held back by that persistent drag of the agency business.
Which Peters said again remains soft and was the primary pressure point.
He did.
So if the creative growth was almost entirely driven by an accounting correction and a one-time deal, what does that mean for the next quarter? What are the Q4 expectations?
This clarity leads directly to the sobering Q4 forecast for creative. Management expects creative growth to fall back dramatically to, and I'm quoting, very, very low single-digit growth in Q4. And this is a direct reflection of the continuing drag from those 22% agency declines and the absence of the non-recurring benefits they saw in Q3. This clarification gives a clear, if very cautious perspective on underlying market conditions for creative going into the end of the year.
That Q&A session was just vital. It sliced right through the one-time noise of Q3. So if we review the key themes that emerged from this deep dive into the GT earnings call, three major concepts really jump out that define the company's current position.
The first, unquestionably, is the balancing act, durability versus volatility.
Okay.
On one side of the scale, you have this incredibly strong, durable performance in the core subscription business, especially the high-value PA agreements and those sticky enterprise customers in the corporate segment.
Which is approaching 60% of total revenue now.
Right. This is the strong structural foundation of Getty's revenue stream.
But on the other side of the scale, those strengths are being offset by this persistent weakness in segments that are really sensitive to external pressures.
The alarming 22% decline in agency revenue.
Right, and the slow, lagging recovery for broadcast and production after the Hollywood strike. And then there's the built-in volatility of the editorial business suffering from those tough calendar comps against the huge 2024 event year.
And the net result is you have this highly durable enterprise business that's being masked by volatility in the project-based segments. And it all results in a flat overall top line.
Theme 2?
Theme 2 is defining the future of AI and protecting IP. Getty is really showing maturity in its approach to AI monetization. They are actively moving beyond the initial model of just selling one-off training data.
Which is what caused that dip in Q3 AI revenue.
Right, because of the prior year acceleration, they're moving into the more strategic space of contextual, attribution-based licensing, and the Perplexity deal is the perfect example. This strategy ensures they participate in the AI economy on terms that secure rights holder value.
And the UK legal win against Stability AI, that's a monumental victory that underpins this whole strategy.
It is. It validates their stance on trademark infringement, and, critically, it provides a powerful legal precedent that places the burden of ensuring clean output squarely on the generative AI platforms.
Not the end user.
Not the end user. They are not just participating in the AI economy, they are actively shaping the legal framework for it in a way that protects their brand and their content globally.
Okay, and finally, theme 3.
Theme 3 is the high cost of waiting for strategic moves. The company said again, 100% committed to the Shutterstock merger. It's strategically vital for long-term cost synergies and market positioning.
But the Phase 2 CMA review pushes the close into 2026.
And that regulatory delay has a very real, tangible financial cost. The $3.5 million per month in net interest expense on that $628 million in escrowed financing.
That's a $42 million annualized interest payment.
It's a clear financial headwind that will drag on profitability until the deal is finalized or terminated. It just shows the immense regulatory burden in major M&A.
So what does this all mean for you, the learner? What's the final so what here, beyond the numbers?
Well, the overall message is one of strategic execution amidst genuine economic and calendar difficulty. The financial results are so sensitive to comparison periods, you constantly have to subtract the ghost of the 2024 Olympics and the prior year's accelerated revenue to find the true underlying trend.
But the most robust parts of the business are still healthy.
The most robust parts, the recurring premium access and enterprise subscription base, they remain structurally healthy, and they are growing. They are a necessary ballast against those volatile, project-based revenue streams. The company's long-term fate, it really hinges on how quickly they can scale these new attribution-based AI licensing deals and realize the cost synergies from that delayed merger.
And this leads to a provocative thought for you to consider. Given the strength of their enterprise focus, how fundamentally reliant is Getty on this durable recurring premium access model versus the higher margin but currently collapsing project-based agency work going forward?
That's the question. Is the 22% agency decline a temporary cyclical problem? Or is it a permanent structural shift where advertisers are bypassing agencies and just buying directly through enterprise contracts?
And what about AI?
Furthermore, while management was reluctant to forecast 2026 AI revenue, they signed multiple licensing deals structured like the Perplexity one in Q3, all of them ensuring attribution and linkbacks. What will be the true cumulative impact of these traditional AI licensing deals once they mature and scale up, finally offering a meaningful recurring top-line contribution in 2026 and beyond?
That remains the big open question for Getty's long-term growth story.
It does.
Excellent insights that really clarify the noise from the signal in this earnings call. That wraps up our deep dive into the Getty Images Q3 earnings call transcript. We appreciate you trusting us to guide you through this complex material.
We hope this analysis gives you a much clearer understanding of GD's strategic challenges, especially the cost of that delayed merger and their underlying strengths in that durable subscription base.
And as always, if you enjoyed this session, please show your support. Click like, share this deep dive with others who need this clarity, and subscribe to the channel right now. Stay tuned for upcoming deep dives designed to keep you informed.
Have a great day.